Hey everyone, good morning. Welcome back to POA for you, and my name is Leroy. Today we're going to go through O Levels 2019, Paper 2, Question 3. The topic is around financial statement analysis, and I hope this will be useful for you. Now, if you find that another friend of yours could benefit from this video, please share it with them. This is a free resource and it should reach as many people as possible. Now, if any point in time in this video you have a question, feel free to ask me via this channel, or you can always email me at poa4u@gmail.com. My email address is always on the top left hand corner of the videos that I do. Now, if you haven't already subscribed, please do so, and put on the notification bell so that you can get notification on new content when I upload them. And if there's any content you want me to work on, send them to me and I'll be more than happy to help out. All right, so let's get right into this. Okay, so this question shows you a table for 2018 and 19 of certain profitability percentage and matrix, right? And they've asked you to calculate the net sales revenue and the expenses for each of these 2 years. That's the first part. So let's address this first part first, right? And I think you can derive the net sales revenues and expense from these few things once you understand how these few percentages are calculated. So I'll just show them to you. Okay, so let's start with this table that I prepared. Before we answer for 2018 and 19 the question, I'll just kind of give you a working example. So let's say if in a normal business or whatever, I have a net sales revenue of 100,000, my gross profit, let's call it 20,000. Then what is my gross profit margin? So what is the formula for this? Because this is essential to answer this question here. It's equals to simply gross profits divided by net sales revenue. Okay, so that's 20%. So the formula, if net sales revenue is A, gross profit is B, and gross profit margin is C, then C equals to B divided by A. All right, so that's as straightforward as that. Now, then, you know, in the normal business, after gross profit, if you remember the structure of your statement of financial performance or your income statement, right? You will have your expenses as the next bucket of stuff to before you derive your your profits, ultimate profits for the business. So let's say if expenses was I don't know, let's call it $8,000 for the year, then your profits would be gross profit minus expenses. So it's 12,000 here. And your profit margins, could you make a guess what your profit margins would be? Yes, it's profits divided by net sales revenue. So the net sales revenues in any margin computation is always the denominator. Okay, so I'm going to put that as that, and I get 12%. So expenses is, if let's say I put it as an indicator of D, E would be profits equals to B, which is gross profit minus D, right? And then profit margins is F, and it's equals to E, which is my profits, divided by A, which is my net sales revenues. So these are the formulas that will be important for you to know before you attempt this question. Okay, now let's try and fill up the blanks for this question itself. So you got certain information like 2018 gross profit is 87150, and 2019 is this 97125. Gross profit margin is 21%, and here it's 18.5. So you can get your sales revenues here, right? If this is gross profit margins is gross profit divided by sales revenues, then sales revenues is gross profit divided by gross profit margins. So that's your number. Okay, and essentially what are we saying here? We're saying that, you know, if you look at the sample example, every $1 of sales revenues, the gross profit is 20%. So that's like 20 cents. right? So every $10 is $2, every 100,000 is 20,000. So similar for this one in 2018, if it's 21%, it means every $1 of sales that you make, you are making a gross profit of 21 cents. And in 2019, that every dollar of sales revenues that you sell, you're making a gross profit of 18.5 cents because the percentage has fallen. So that's the appreciation that you should have when you look at these numbers as well. Now let's look at this next part, right? The next part is they tell you profit margins. You have 12% here and you have 7.5%. Then you can calculate what your profits is with the profit margin, right? So profits is equals to 12% times net sales revenue. So this is your profits, right? And then you can then work backwards to calculate your expense, which is your gross profit minus your profits, your overall profits. And that is the answer for part 1 and part 2 of section A. Alright, so moving along to part B, let's see what we need to do. They've asked us to comment on the change of gross profit margins from the year 2018 to 2019. So when they ask you to comment, you probably need to set an observation. And what does the observation mean? And also potential reasons of why you're observing this, right? So if you look at the gross profit margins, that's the first part B, right? Margins have dropped from gross profit margins have dropped from 21% to 18.5%. That's the first observation that you must make, you know, from 2018 to 19. And that means that, like I said before, every dollar that you sell, or the business sells, they are making less gross profits. Now, why is this so? If you think about it, gross profit is actually, if let's say you're selling books, right? So it's the profits made from the sale of books itself, excluding all other costs. So it's the cost of your books, or rather the selling price of your books less the cost of your books, right? And the cost of your books would be the cost that you pay your supplier to buy the books, plus, you know, transportation costs to bring the books in to the stores and stuff like that. So why would this happen? Now, if you look at this additional information here, they say that they've expanded to new stores and also new range of products. They've also increased promotions and advertising, changed suppliers, and also invested more in additional stuff to keep up service standards. Some of this would affect gross profit. So for example, when you increase range of products, if you are selling books, but then at the same time you sell stationery, you sell like pen, pencil and stuff like that, the margin profile for different products could be different. Maybe books are very high margin products, right? When you sell one book, somehow the economies of it, you could make more money or more gross profits from selling books, right? Either because you can command a higher selling price or the cost is very low. But if you extend to a new range of products like pens and stuff, it may be a new business for you. Your volumes are not big enough, and so your cost is high, or your selling price is not competitive. You can't push up the selling price because you don't have the credentials or the market strength to do that, right? So those are some of the reasons that that gross profits may have decreased. And also, if they're doing a lot of promotions, they may also be slashing prices. So if they're slashing their selling prices, then your gross profits will be impacted and will fall as well. So this is the answers that I've drafted. Margins have fell. It means that every dollar of sales revenue generates less profits. So product expansion, less gross margins on maybe the new products versus the existing products, like I mentioned earlier, and also increase market share. You want additional promotion, so prices would have reduced. So when prices go down, your gross margins will be impacted. And also the thing is, they had some new suppliers. And because the new suppliers, maybe because they change the suppliers because of higher costs or whatever reason, but maybe the new suppliers would come at a higher cost to them. So it will increase cost of sales, therefore lower gross profits. Now, the next question is on the same thing, but on profit margin. So the last profit margin line, the overall profit margin line. And this overall profit margin line is impacted by how gross profit margin moves. So if gross profit is higher, then of course the bottom profit, the bottom line, before they call it net profit, would be higher as well. But the other thing that would influence it is expenses. If you spend more, right? If you look at this waterfall here, after gross profit is expenses, then you will get your final profit. If your expenses are higher for whatever reason, like you're spending on additional staff to ensure service quality is higher, then that could be it. Your expenses is higher because you're paying more rental for small stores, then that could be it. And if the small stores, especially, they are not selling as well for you, then it would creep up into higher expenses, which would reduce your profitability. So I've prepared a statement here for you guys as well, which echoes what I've just explained, and hopefully that will help you absorb this. Now the last part is 2 ways how you can improve profitability, and it's important, right? Because in future, if any of you have your own business, you want to assess the gross profitability and the net profitability, because both are managed differently. Gross profitability can be managed through inventory cost control and pricing management, which includes promotion management as well. And your overall profitability could be managed by expense control, controlling your expenses to see what are really necessary, what are non-discretionary that you really have to spend, and what are really discretionary that you can defer. Okay, so I've put in 2 ways to increase profitability. You could increase the price of your products, especially for some range of products where there is really strong demand, and your products is a leader in the market and they reflect better quality and service standard. And therefore, when you increase the price of the products, consumers will still buy. And when consumers still buy, then your overall profitability from selling that product will be higher. And you could also reduce non-critical expense or find cheaper ways to advertise, right? Because today, traditional TV advertising and things like traditional TV media is very expensive, and it's less expensive than the counterparts of social media and stuff like that, which also could be more direct to consumers and effective. So these are options that you could consider for this question. All right, so that's about it for today's session. I hope it's been enjoyable. I mean, it's always fun for me to share this kind of stuff with you guys. Any questions, you know where to reach me. And if you like the video, give a thumbs up, and most importantly, share it with your friends who need them, because I think this is an important free resource that you can just share it with anybody who you think could benefit from. And thanks so much. Take care for now.